Welcome, everyone. I'm John Ryan. Welcome to the Manny's Irish Pub Financial Futures and Trading Show for Friday, June the 23rd, 2023. I'm going to be joined shortly by Steve Merrill, of course. He's just running a little bit late. We're going to go about 15 minutes today as I have a scheduled show on ESPN Syracuse at 1:30. You can tune into that show as well. Just by following on the timeline, there'll be a link with how to get to the show, and just click on the link and you'll get some pretty good sports news there and sports betting ideas and strategies. But this show is focused on the financial markets. So until Steve gets here, I'm going to just kind of run solo. You can see on the chart here, we're looking at a chart of the 10-year note. Now, this is the price of the 10-year note. So what this is showing you is that when the price is going down in a downward slope, that means yields are going up. So at the low there at 108 and 26 and a half, 30 seconds in price, that was the beginning of the Fed tightening last October. And what we have here is very important to note, because the Federal Reserve, many of the Fed governors announced this week that there's going to be two more tightenings over the remaining part of the year. And you can't try to figure out whether they're actually going to do it or not. They probably are, maybe only 25 basis points each, but nevertheless, it's going higher. But notice on the 10-year note, it made the low way back last October, and every single tightening since, which has been a meteoric rise in interest rates over a very short period of time, especially when you look at historical Fed tightening cycles, you can see that the 10-year did not make a new low, meaning that the 10-year yield did not go in tandem with the Federal Reserve movements. And what that tells you is that this inflation bug that was a big scare back in October of last year is really not a scare anymore. We're going to look at crude oil here in a second, and that's lost half its value in the past 6 months during that time period. Heating oil has come down dramatically. Crude oil itself, but that has to do with a arbitrage that they still do in the trading world called the crack spread, and that is the difference between unleaded heating oil and crude oil, because crude oil has all kinds of derivatives. Jet fuel, for example, is a derivative of crude oil. Anyway, this is very bullish news. The one concern I do have is that the fear factor gauge is at the lowest level since January of 2020. And what that means is that there's too much complacency in the market, and there's this big rally has removed a lot of the fears that were present last October when the Fed announced that they were going to really raise rates fast, and that did scare everybody. And the fear factor obviously was at the other extreme than where it is now. It's not a real big deal, though, because short interest right now, and this is another term for new investors out there, short interest are bets that are made in expectation that stocks are going to go down in value. That is at a record amount. Over $1 trillion worth of short bets have been made in the marketplace, and that is a very bullish type of situation. If the market doesn't go down, and a lot of these positions are already down 10% because of the rally that we've seen in the last couple of months, they're going to have to cover those short positions or risk losing more money. Once they start covering, that is really going to propel this thing a lot higher potentially. So I think the fear factor gauge, I wouldn't worry too much about that because that can change month to month. But I think what is really the dominant factor here is the short interest of being over $1 trillion bet that the market's going down. And that's always a precursor to the direct opposite happening. So I do think that is a very bullish reading there. You can also see on the chart here with the correlation trend indicator I put up. This is actually the same type of correlation trend indicator I use in the sports betting analysis that I do for teams, and even the sports analysis aside from betting. The only difference is that the column headings are different. So instead of price, we have yards gained or points scored. And it's the same mathematics, just applied in a different industry. So you can see here we have the correlation trend is going down a little bit right now, but again, it's in a neutral territory, so there's no reason to get excited about a possible nosedive here. The market is down, obviously. Let's go to the S&P 500 here. And we made the high 3 days ago at 44.9375, and that is about a 23.6% retracement of the whole big move from the all-time highs to the lows made last October when the Fed began tightening. So those are Fibonacci retracements. Fibonacci numbers are 1, 2, 3, 5, 8, 13, 21, and so on and so forth. Simply adding the two previous numbers in the series to get the next one, so on and so forth. You take a ratio of those numbers and you get these retracement levels. The big one over the last couple of months has been right here in the 50% area, where it really was banging up against it, and then it would fail, and then it would try again. But you can see once we got through it, that was at 41.58. We're now 340 points above that, which is basically 2,400 Dow Industrial points equivalent. So that's a very, very powerful sign. And I think any consolidation here, or even a downtrend in the market, which we are seeing today, is not going to last very long. Our low today is 43.84, and on the S&P futures, and we're significantly above that. We're back above 4,400 here, and despite the news, we're doing very, very well. And Mr. Merrill, how are you?
John, doing well. Doing
Thanks,
well.
thanks for joining here. I know Fridays are very busy for you, and I was just going over the bullish divergences that we're seeing. I mentioned that the short interest ratio is at an all-time record high of over $8 trillion worth of short positions, which that's a contrary indicator being bullish that this market probably does go higher, despite the fact that Jerome Powell said that they're going to tighten 2 more times between now and year end. So you agree with that? You bullish, bearish?
Hey, well, I mean, I've been sidewayish, and that's obviously played out here the last several months, right? We had that pretty hard drop down, and then it's been somewhat of a little bit of a trend back up, as you see there, but it's a short-term trend. My big picture takeaway, though, the market is still a bit overpriced. I mean, the U.S. market compared to the international markets is still above its average price. If you look at a 10-year Cape-Shiller ratio, whatever you want to look at, cyclical earnings, price ratio. So I still think it's a better bet to being diversified in an international portfolio than the S&P necessarily. But it does look like in the short term the trend is going up a little bit, but I'm not a buyer necessarily. I like what you said about the short interest, by the way. It makes a lot of sense. If you have a lot of short interest that's ticking higher, it's kind of like that is a little bit of a bottom indicator because there's not much more negativity can be built in if there's a lot of short interest and it's still going higher. But I think long term, next year or two, I think we still got some problems in the overall economy.
I changed the chart to the Nikkei because you mentioned the
Yeah, I mean,
international
and
fund.
that's like a 40-year bear market, right? I mean, until recently. So I mean, they're I'd be real quick on Japan. I mean, there's some concern that's where we're heading, by the way, too. People don't think things can just go bad for decades, but I mean, they did in Japan, and that's a market that's been due to break out for decades now. So that's interesting.
And Warren Buffett is a big buyer. Is
Interesting.
the talk this last couple of weeks? Whether it comes out to be true that he actually is in there or not remains to be seen. But he carries a pretty big stick. So if he's in there, and he notoriously does contrary situations where it looks like it could be the worst investment of all time. I remember Norfolk Southern Railroad was one of those head scratchers. He was buying banks during the Taiwanese crisis in 1998 when nobody in the world wanted to touch them. But we'll have to wait and see. Let's take a look at crude oil because I mentioned that at the start. And this is where I say there's no way that we have inflationary pressures like the media leads you to believe. It's just not there
Right.
in a traditional way. And you can see this is crude oil, and you don't have to be a rocket scientist to understand that this has been going down. And now we're at 68.85, which is nearly 50% lower than the peak back in October of last year. So I'm not a real big fan of this inflationary scare and the that it's going to be out of control in another couple of months. That just seems to be very unrealistic.
Yeah, I mean, there's obviously different things to look at with inflation. I think that's something I'm still kind of learning on the fly as well because you're a little bit older than me, John, but both of us are fairly young and yeah, fairly young enough to really have not seen much inflation in recent decades, right? I mean, and you and I both remember the '70s because we were around in the '70s, but history doesn't repeat itself; it rhymes. I think is more accurate,
Yeah.
and it's just like the '08 was real estate related. This one's a little bit different, but I still think there's some bad stuff that could happen with the economy, as I mentioned earlier. I'll use some indicators. I use a lot of it's just common sense. When I talk about eggs a lot, the price of eggs
Yeah.
have been fascinating. I mean, you and I talked about it the other week. We talked. You mentioned I think it had been traded at one point, but I wish there was a futures market on eggs right now because just going to I like Aldi. Aldi's a German grocery store that's in the U.S. now. Eggs were like 80, 90 cents the past couple years. Last year they went up to like $1 or $2, and then they went as high as 4.5. Now I know some states are like $8, $9, but it went to $4.5 in my market like about 6 months ago, 8 months ago. Then within a week or two, they were like at $2.5. I went back a day later to get something else. They were like went from 260 to 215 in one day, mid dollars, and now they're like $1.10 when I was in there last week. And I'm not a huge egg guy. I like eggs. I like protein, but it's been fascinating to me. And when in recent history have you seen any normal commodity like that in a grocery store go up 400 or 500% within a couple months? And there were some other things, not just the transportation issues, some kind of chicken issue or something, but something's not right when it goes up from 80 cents to $4.5 and is back to $1 within like 6 months later. But that does make me think the inflation is waning. And like you said, the crude oil price is a great indicator as well. Look, there's real money in these markets, right? Just like the sports betting markets. There's real money here, just like the presidential markets in Europe. I love to follow those, as you know, because it's real money. It's not just people being called in a telephone answering a poll question. So if you want to see where things are heading, you look at the futures contracts because these are people that do this on a daily basis and have a lot on the line. And oil's heading down. You're right.
Yeah, I think the thing with eggs is very good because it's used in a lot of different things. It's not just
Yeah, it's a
eggs that we're
basic thing,
eating.
right? I mean, right? Yeah.
It is involved in a lot of baking and cooking. The only difference I do think is that when you go to the gas pump, you're basically getting if you want 40 gallons of gas, that is the equivalent of 40 dozen eggs, which nobody eats in a week. But most people, I think, probably burn the equivalent of $40 worth of gas a week. So it has a little bit bigger
John, I'll say this
impetus.
real quick though. Like I used to see maybe one Tesla a week in Williamsburg, where I am, and I started seeing a couple more. And it's been noticeable within the last 6 months to a year. I see 5 to 10 a day on like a 3 mile commute. It's been off the charts within the last year or so. So I do think we're getting closer to 10, 20% of the people having an electric car than we realize in the next couple of years. I think that's going to be exponential. And the other reason is because the Model 3 came out in 2018, and there's a lot of used ones on the market now. It's becoming very affordable for people to get a Tesla for like under $30,000. And there again, it's like the egg thing, right? It's just like a common sense eye test. I'd see one a week. I see 5 or 6 a day now on the roads, and that's been overnight. I go in like a Panera. I come out. There's always one in the parking spot. I just never see it. I see one every day now. So, and it's a different one. So, I think that's something else with oil and gas. We got to keep an eye on. That's coming sooner than we might realize. Now, that's going to cause other problems. I don't think it saves you any money. Electricity prices are going up.
Yeah.
Batteries are, terrible for the environment. I mean, so that's a whole different topic for discussion. But I do think there'll be less gas-powered cars year after year, and it might be an exponential ratio that we're not even prepared for as far as that plunge.
Yeah, I think you and I talked a couple of weeks ago about the fact that electric cars, when you're charging your electric car,
Yeah,
it's being powered by fossil fuels. So at what point do we get too many electric cars, and then that hurts the environment? I
exactly
think
right.
that's the other wild card.
And what do you think? I mean, look, I don't think oil's, coal, obviously, there again, it's hard to find coal futures. I wish you could get coal futures as well. natural gas is one that's interested me, John, since we've talked, we haven't talked for a few months. I mean, natural gas just plunged all the way down. It's really been steadily just kind of in a sideways bottom channel, even with all the uncertainty overseas and whatnot. Yeah, look at that there. I mean, it's just
Yeah, I mean, it's
the
super.
risk reward up on that is pretty good in my opinion. Would you agree? I mean, it's almost bottomed out now where the moving average is almost catching up to it now. And that might be one. Let me ask you this, because I know you have to run in a little bit, but you talked about short sentiment, short selling. What do you think's a good indicator in the commodity markets for like a sentiment indicator? Because I've been trying to do some research on that because I'd love to like start going long something like this when the sentiment is really negative, but I don't know how to really define sentiment for commodities. I know there's
It's
relative strength, but it doesn't really do what I'm looking for.
that's a great question. It's the commitment of traders report,
Okay.
and it may be called something else now. I can research that
Let
and
me
get
know.
a
Yeah, message me and we'll talk about it next week, maybe on an episode, because that's something I'm really been digging into.
yeah. It used to
Because
be large traders, which were the locals that were in the pits, running their own accounts, but very very large um, wealth, and that's what they do. They create markets. Then you have the institutional traders, which are equally large, and then you have the small lot guys that are doing 5 contracts, 10 contracts, or even 1 contract, and they break it up based on all three. So it's very similar to the sports betting markets, like you and I know, where the Joes and the pros, and the
it's kind
pros
of, yeah, kind
obviously
of what
are.
I'm looking at. Exactly. Yeah. Like
Yep.
a fade the public type thing for the markets is kind of where I'm
Yeah.
going with it. I think that's a great analogy. I think volume maybe is something you could use as well. You and I talk about volume a lot. You see something just kind of bottoming out like this and see how it's just a smooth, consistent bottom now for, several weeks, even months. Um, and when you start seeing some volume spikes up and when things start to rise, I think sometimes that can be an indicator the big boys are coming back in the other way.
We have a question from Nick here, real quick before we sign off. Let's see.
Well, I mean,
Well,
my quick answer to that, Nick, would be if you're doing an ETF, you're not going to have to worry about it, right? I mean, an ETF of an index, like you could buy the Nikkei index in an ETF, and that's a U.S. traded fund. So that would be my quick thought on that, on tax issues for international markets and whatnot.
yeah, for sure. I agree 100%. And you really shouldn't let tax rates enter into your trading strategy in the first place, because if you're making money trading, then you will have the money to pay the taxes, and then that's the game.
Yeah, I've always loved that, John. Like people complain because they're not. Well, I mean, look, I don't get started on the tax rates. I think they're too high. But like, if you're complaining because you're in a higher tax rate, you're still coming out ahead. You're not going like having to pay 110% at any rate. So, yeah,
Exactly
exactly
right.
right. Now there are. With that said, though, and I know people will jump on us for saying it's that simple because there are some strategies you can use, to defer and whatnot, where it is more tax efficient. But ETFs in general nowadays are very tax efficient. So there again, if you're looking to invest in Japan like Warren Buffett might be doing, just buy the Japanese ETF, the index, just buy it long, and it's going to be a very tax efficient, low expense strategy to do so.
I agree. And I'll make this kind of my best bet for the show, like we do in the sports shows that we do together. And the Fade the Public show, people, a big shout out here for Steve. I'm not kidding you. It's one that I watch personally, one of the few shows that I watch that is not done, with myself and other guests. And it is really, really good. And he has an excellent track record with the NFL, and it's definitely worth watching. And that's only a few weeks away, Steve.
Yeah, it's incredible. Yeah, we won't do it in the preseason. I haven't figured out how to fade the public in the preseason yet, but yeah, we started it back in 2020 in November, and it went 31-8 the last half of the season. So, needless to say, I've been doing the full season version since, and that's at Wager Talk TV, wagertalk.com. Wager Talk TV. Just hit subscribe, and you'll get an instant alert in a couple months in September when that fade the public video goes live for week 1.
Yeah, it's good stuff. So I'm looking at DraftKings here, and I'm not ready to really step into the water, only because it's underperformed the overall market. But it is trending sideways. It's building a base. Their problem is obviously debt, and they've had to put out a lot of money every time a state goes legal. They have to put out an absolute monster number just to get the promotions out there, teach people how to open accounts, put the customer service people in place, and it's a big number. Reminds me of when in the FDA, when a biotech company gets a drug approved, then all of a sudden they have a cash burn that is just enormous. Hiring the salespeople, hiring the back office people, even, and then marketing the drug that hopefully is going to sell really well since it's FDA approved. But it's a tremendous gamble, and I think that's about where DraftKings is right now. And once all the states finish their legislation, whether they're going to do it or not, Florida, Texas, California, I wish would just kind of wake up and get it over with. It's just they're losing tens of millions of dollars literally every single month by not having it available to people. But hopefully that'll change. But I do like an idea of scaling into DraftKings here, anything north of 22. I'm sorry, south of 22, and that's my call for the show.
Yeah, I'm with you on that. I think it looks like a little bit of a double bottom forming there, and I would say the breakout from a little bit back there, that mid-size up spike there, would probably be a good breakout point there. But it does look like maybe a little bit of a double bottom is trying to form there, or at least a near-term bottom. And this is a company that's not going to go out of business, because the great thing about being long stocks, you can only go to zero. That's the old saying, right? When you short it, you can lose infinitely. This one's not going to zero. FanDuel and DraftKings are the power players. Reminds me a little bit of Amazon was the analogy I was going to use, where they might not be profitable, but they're going to basically own the market here in the near future. And I think risk reward up is pretty good on DraftKings.
Absolutely. One last thing here from Nick. I'm gonna make note of this, and we're gonna put this on next Friday's show with the mining stocks, which I historically have just hated the mining stocks because you really don't know what's going on, and all you have to do is have one or two or three accidents, and then not find a vein, and it's really risky stuff, especially the Canadian miners. You just don't, in my opinion, Steve, I think you would agree, you just want to stay away from them.
Right.
There's too many other opportunities out there that are so much better.
Well, I mean, my quick takeaway on it is that just play even if it's the commodity markets are too complicated, just play the USO ETF for oil or the UNG ETF for natural gas. I mean, for the most part, they're pretty correlated with the mining companies with a lot less, downside risk, like you said, trying to pick an individual winner or loser.
Yep. Well, unfortunately, it brings us to the end of this one, Steve, but I appreciate your time, and we'll be on again next Friday at 1 o'clock. I'm going on ESPN Syracuse here in about 5 minutes, so awesome. I got to switch gears a little bit. I mean, it's kind of the same thing, but, we're talking about ups and downs and wins and losses, so it's about the same thing. But until next week, make sure you check out Steve Merrill over at wagertalk.com. You can check all my stuff out at predictiveplaybook.com. And until then, I guess I have to end this show the same way as I do the other one, Steve. Invest with your head and not over it. May all the wins be yours. Thanks for watching.